Good afternoon. Welcome to today's webinar sponsored by OnApproach. My name is Peter Keers. I'm Senior Engagement Manager for OnApproach, and I'll be moderator for today's session. Our topic today is segmentation is everything. Mathematically, it's actually more. Today's presenter is Steven Simpson PhD. Steven is CEO of FinTech Data Science Consulting. He is an experienced banker, consultant, and university professor with over 30 years of experience working with financial institutions. He's passionate about helping credit unions succeed by leveling the advanced analytics playing field. There will be a question and answer at the end of the presentation. Also, please feel free to ask questions via the chat or the questions function. With that, Steven, I'll turn the presentation over to you.
All right, thanks, Pete, and appreciate everyone's time spent in enjoying this presentation today or listening to it in its recorded mode. I welcome any questions, of course, at the contact information here on the screen, and also would like to take a moment to thank OnApproach for their passion in leading in analytics for the credit union industry. Got a great data warehouse product, and they're passionate about helping credit unions with information series like this one. So my goal today is hopefully everyone will get some tangible things that you can take and start having an impact at your credit union today. Today we're talking about segmentation, but with any analytics project, I like to stress that we should start simple, have a goal, seek to deliver an immediate ROI. Too often, we get wound up in resolving data silos and creating a single source of the truth and getting all data into one space. That is certainly a great goal, but it's a journey. It's going to take us a long time and several iterations to actually get to that point. We definitely want to start early and start soon. I can tell you that at a recent Microsoft Credit Union Analytics Symposium, we had a great CEO session, and each of those three leading industry CEOs stressed that before they started their analytics journey, they were very surprised that they really were not asking the right questions, that the questions they're asking today are much different than the questions they were asking or that they thought needed answers to, and they also have had their intuition challenged by analytical results. So it's important to start earlier, but to start, just start simple, try to answer some questions for data that you know that you have, and again, start delivering immediate ROI, and that can be done as simply as meet with the line of business leaders, understand what their goals are, and try to provide them meaningful, actionable data that help them succeed in their lines of business. Segmentation is the key. The opportunities within the credit union data will be revealed through segmentation. You can notice a trend here. The reason segmentation is so important is we're going to talk about several segments within your data, and the fact is that an extreme minority produces an extreme majority within several key segments. And then, of course, when you're taking measured action, segmentation is the key because it will help reveal the recurring best practices, which are ultimately what we want to result. So when I say segmentation is everything, and mathematically it's even more, it's a little bit tongue-in-cheek, but statistically it's actually true. So for example, a very key segment that actually the majority of credit unions in the industry don't have is member contribution. Member contribution, I think, is an important segment. There's certainly many things that you can do with segmentation and analytics if you don't know your member contributions, but once you know member contributions, I think a lot of the actions that you'll take will be different because you'll be focusing on different segments of member contribution logically differently. So for example, 1 to 2% of members actually are going to produce about 120 to 200% of your member contribution. The next 3 to 15 percentiles will produce another 100%, and then member contribution will turn negative if you're around the 16th, maybe 15, maybe 18 percentiles, but I've literally not found it outside of 14 to 18% if you've allocated all of your overhead and it's a risk-adjusted, risk-weighted, capital-costed model. I find it unbelievably consistent, and that is with right around 50 models deployed. So 16 to 89%, those people are just slightly negative. And so, of course, when we're looking in that segment, what's the next product or service that could just bump them into the positive member contribution range? But aggregated, that segment actually erodes about 80 to 150% of member contribution. And in the bottom 10 percentiles, we know we have bankruptcy notices where their assets are in asset recovery department. We are paying lawyer bills related to these members. So those bottom 10%, we often know their loans are in non-accrual. And so, of course, that bottom 10% eats up another 100%, maybe even as high as 120, 130%. And so what results is a net of 100%. Now, obviously, within these different segments, your actions are going to be quite different. I would submit that your 1%, you want an officer assigned to every member. Someone needs to be able to recognize the person and be their primary contact if they need any service. And after you get that 1% tackled, you move on to the 2 through 5%, right? Maybe those 2 through 5%, you ultimately want an officer assigned to deliver that added level of service to all of those members. That's a great group to ask for referrals. Those people run in the same circles. They may own small businesses. They may be on the same Chamber of Commerce or hospital boards or church groups with like folks. And so attending their small business events or asking them for referrals could bring other members just like them, which of course, if you could increase those couple of percentage points and bring members in there, very important. I'd also tell you an important segment is knowing, let's say, quantifying the dollar amount of limit. Let's say that these people produce $2,500 a year in member contribution. The goal is to recognize those members at the 2-week and 2-month point so that next year, instead of having 2% of our members that contribute more than $2,500 in member contribution, we're at 3%. And the next year, we're at 4%. And we're swinging some of these percentages into this bucket. Okay, more on that in a moment. But you'll find that segmentation is an extreme minority, produces an extreme majority in many things. Our debit card and credit card interchange income, I will wager that if you look at your active debit card members, not the debit card members, not the members that have a card, but let's say the ones that have had a debit card transaction in the last 30 days, let's consider that those are active. Out of even that smaller group of members, 15% of those members will likely produce 85% of your interchange income. So again, wouldn't that be a great list of members to have, knowing that they account for that much of my important fee income percentage? You'll find similar concentrations in internet banking logins, bill payment. An interesting stat, those highest volume debit card users are typically in the 40, 60, or 80 transactions per month category, right? So obviously, those are the people I'm going to look to enroll in a rewards program. Those that are using it 1 to 5%, my message completely different. Those that are using debit card but more PIN than signature, my messaging is completely different. And so again, segmentation is the key. And certainly our CECL models focus on segmentation when we're talking about a vintage type model versus a FICO bands within certain loan ranges, and then overlaid with LTV and DTI. So a lot of this in one recurring theme we're going to build towards are kind of overlapping segments point to action. Digging in a little bit more for a moment on a profit metric or a member contribution, here are some real results of a recent credit union analysis. So notice that my percentile number 1, these are all 10% ranges, but the first 10% are broken out into individual 1% goals. So you can see out of 4,900 members, the 49 member households produce this much of total member contribution, right? Now, interestingly, they also have the highest count of services per household until you start getting down into the bottom. So you notice this is a U-shaped curve, which is very often the case. Our onboarding and our cross-sells are done best, fortunately, within our best members, and they're our highest members in terms of contribution because they're using the ideal mix of our products and services. But in our cross-selling and onboarding, we also succeed in selling the people that come into the branch often, the people that we know, the people that beat us up a little bit for the higher rates of CDs, and we waive their fees because we know them. And with member contribution, we actually reveal that they are in the lowest segment of member contribution because they get the little bit lower loan rate, the little bit higher deposit rate, and we waive their fees, right? And so all of those things mathematically result in them being in these lower bands. So our cross-selling would be quite a bit different if the field knew that this was a gold, silver, platinum member, or 1 star, 2 stars, 3 stars. However you'd like to categorize it. You're probably not going to give them the dollar amount contribution, but you're probably going to give them something to indicate that range. Okay. Another way to look at it is even within member contribution, segmentation is key. Here is a band of members that have a checking account and use their debit card, and both result in negative member contribution. They're losing this on average $86 per year in the checking account. They're losing us $93 in their use of the debit card versus this band that has the same 2 products and services, but yet they make us $108 on their use of the checking account, and they make us $84 on the debit card. So down here we have people that use their card infrequently or maybe use only PIN transactions that result in a transaction fee, as opposed to a lot of my credit POS transactions that generate interchange income. Here I've got either high balances and fees. Here I have low dollar checking accounts, but yet I waive the fees or they don't produce fees. And then maybe I've succeeded in selling them yet another checking account to keep a very low balance in where I'm waiving the fee. Okay? So it's important even after member contribution to understand the segments within member contribution. Continuing on that in member contribution, to know my percentile, my source of contribution. Do they get there in the top percentiles? If I look at my top 5%, I'm going to find that they were top 5% because of their loan contribution, their high deposit compensating balances, or possibly their production of fees, or maybe it's a combination of the 3. But if it's predominantly one or the other or the third, then I'm going to focus messaging on them so that I get the more rounded relationship, right? Or possibly I can't get any more business from them. I maybe ask them for a referral. But to be able to see my members in the households is very important. So ask yourself, do you have a household equation? I know that OnApproach is working on a household equation. and already has a nice one planned out, and with the data in their warehouse can easily be accomplished. An engagement metric is very easy to calculate. So what is the contribution of additional products and services? And what if you were to quantify a very simple algorithm of their transactions? So, you know, let's say that this very simple equation could very easily illuminate the difference in our indirect auto members that never engage with us. Maybe we gave them a little rate consideration on that mortgage loan. Maybe we gave them a little rate consideration on that auto loan if they would make the recurring payment from the checking account at the credit union. But yet, when we analyze that with an engagement algorithm, what we reveal is, let's say, everyone with a score of below 5. We know that they're only making a deposit a couple of days before that payment comes out. And so they have not moved over their ACH deposit. They're not writing any checks. They're not generating any interchange income through debit card transactions. They're not maybe logging on to internet banking transactions. Think of all these service counts and transaction counts that we would probably give slightly different weights to. A check is probably a lesser value than a debit card interchange income producing transaction, and a recurring debit card transaction is probably even higher than that. So imagine that we score these things based on transaction, number of events like logons or bill pay transactions, fees, etc., plus what are the values for different products and services. And now we could look at the relative engagement with our members, right? So what's their use of products and services? And when we segment our executive versus millennials versus retirees, I think that segmenting them based on age is a fine place to start, but you'll find that what is really revealed if you look at their use of products and services. Let's say that you wind up with a 24-year-old that you categorize as a retiree because they only have CDs and savings balances. They really don't engage in checking, and they seem to have the need for no loans. Yet you realize that they're 24, recent college grad, so that you would categorize them as a retiree segmented with their age. That intersection is going to create an obvious intuitive action, right? They're obviously using the credit union probably maybe from their parents opening the account, and they have some accounts, but they don't really use them. And there's an opportunity to engage with that person. You may also have a 55-year-old that you categorize as a millennial because they're a frequent user of mobile. You have their cell phone number where you could send text or email messages. They have a lot of internet banking logons. They log in almost daily. That correlates to their loss rates. And so frequent mobile or internet banking logins, you're going to have less checking account fraud losses and debit card claims because they're seeing their transactions every day. They're going to report those things very quickly. So you'll actually have a lower loss rate in some of those folks. But again, if you have a 55-year-old that's categorized as a millennial, you're going to market to him through text or email messages instead of print stuff mail. And you may recognize what he most prefers to respond to. So again, several segmentations are revealed, and you can develop a best practice action by doing these segments. And it's all about delivering the right message through the right channel at the right time to the right member, right? And I'd even say using the right approach. Ideally, we want to get down and have a next product model where we break out a segment of one member, and we know that, hey, at 2 weeks, at 2 months, we recognize you as this type of member, and we think these products and services would be of great use to you. We're having good success pitching these things with good reasons why, and we are herding that room full of cats towards, instead of having 2 percentiles that contribute over $2,500 per year, we end up with 3 percentiles because we're moving people into that bucket more successfully by having these intersection overlaps within the segmentation. So also segmentation and the use of the engagement metric is keeping more of what you have. Some very practical application. Imagine with the engagement metric, you can now see within a good contribution range, I suddenly start having a member with a declining engagement metric. Maybe they missed the ACH deposit. They're using debit card transactions less. Maybe they have nice use of the credit card and they're purchasing airline tickets and things on a recurring basis, and now all of a sudden that use starts to fall off. It looks like maybe they are starting to use a different reward program card. Maybe we need to change them into a different program. Or maybe they have moved or are moving, but it could also be that they just had a bad experience and they're starting to pull away from the credit union. Today, people don't quit a credit union in a day. It takes weeks to move over all the recurring ACH and move their payroll and change all their debit card recurring transactions. So if we can recognize them, then we want to take immediate action. But we can also look at the engagement metric on a branch or maybe on an employee and find someone that consistently performs best for all new members at the 2-week point. Maybe we could have a webinar and let that person speak to a larger group of peers and share with them how they have success, and we can write that up and elevate the performance of all. An engagement metric may trigger normal than higher deposits, so we can have a trigger that we take immediate action on, try to get them into our brokerage referral relationship or offer them a higher rate CD to retain some of those deposits at the credit union rather than having them move over to a different financial institution. Again, having a next product model within the different member segments to where we can measure that member engagement. We may take a look at our top 5 percentiles of contribution that have a relatively low engagement. It may be very static, it may be very stable, but still we want those percentages to engage with us much more. So we may focus, well, let's get them on bill pay, let's get them on use of the mobile application in addition to the internet banking, just because all of those different service relationships increases our retention. And so what happens is we extend that member average life, and that results in extending that member average lifetime value, which in the right segments can be very substantial to the credit union. So again, segmentation is the key. Here's a slide of several takeaways for you, where what are some tactical opportunities I could do with simple segmentation. And some of these segment opportunities is, a lot of times we don't have the income of our members. Of course, it resides in some loan origination platforms, but if it's not in the consumer lending platform or in our mortgage platform, does that make it over to the core, or does it just live in that origination platform? If we could get those income numbers over into our core platform and ultimately into the data warehouse like the M360 product of OnApproach, then with that income knowledge, we also may be able to make a lot of different attempts to add on products or services. But for a great many of our members, we don't have income. I'd submit that if you just aggregate their deposits on a monthly basis, stamp those and set them aside into a database, take a 3-month running average of their deposits, that's a pretty good proxy to income. Now, from knowing who their employer is, maybe at account opening, you may be able to surmise, I obviously don't have this person's full checking account because I know they must make more than this. And so they're, by their income proxy, it's illogical based on who I know they work for or the amount of their mortgage, or it's very different. Let's say they did do a loan with us. It's very different than what they said their income is. So, do I want to pursue them to maybe get a higher share of the wallet and have more of their deposit business? When I look at renewing loans, particularly if you have a small business portfolio, you can make a significantly immediate ROI contribution if you'll just segment the renewing loans into 3 buckets. First, break down, are they above or below the weighted average rate for the loans that are renewing of that type? How's that weighted average rate of loans renewing versus the total portfolio versus your new repricing example? For example, today, loans that are renewing, of course, are going to reprice up because rates have moved up. But when we're looking at those loans above the weighted average rate, we're going to want to look at those 4 to 8 months in ahead of when they renew. We're going to want those loan officers to have those loan packets in their cars and stop by with those members, take them to lunch and get those higher priced credits renewed before they start comparing us to competition. But below the weighted average rate, we want to slice that bucket into 2 different segments. Below the weighted average rate for loans renewing, are they a member with positive member contribution? It may be that that one credit was just the low priced accommodation made to an excellent member. Versus it may be a member that doesn't keep many deposits with us, beats us up on fees, beats us up on higher deposit rates, and we waive a lot of fees for, and yet they're priced low in that credit relationship and they have a negative member contribution. Imagine the Boolean decision of, I can either renew this or not renewing it. And if I don't renew this credit, it's accretive to the credit union. I mean, our member contribution goes up if I don't renew this loan. Now, I would submit to those, why would you renew the loan, right? So you can, by segmenting your renewing loans, just having that information through the segments, a lot of these decisions are intuitive and quite simple, right? How about looking at all of my CD deposit members that don't have loans? If you break down their FICO, low versus high FICO, and maybe you're doing a soft pull per year, and I look at my low FICO members, I could raise their FICO score by getting them into a CD secured line of credit. Versus my high FICO members, I can't really improve their FICO much with a CD secured line of credit. So of course my messaging there would be peace of mind, able to tap that liquidity easily. And what happens is now that CD is tied to a line of credit. I'm making a little non-interest income on that annual rate for that line of credit. You'll be surprised that those people that say they don't need a loan, but they will take the line of credit just for peace of mind and for the timing differences in their cash flow for liquidity purposes. You'll be surprised at how much of a credit balance you'll wind up with in that segment because they actually will use that line of credit. And then, of course, their repricing on the CD becomes a lot less, it becomes a lot more flexible because they're not going to insist on that extra 25 basis points because they enjoy the convenience of having that line of credit tied to it. Our opportunities from credit reports of loan and auto mortgage members, that credit report offers a lot of information on if they have loans, credit cards, and auto loans with other financial institutions. Again, with an engagement metric, onboarding is now, I can tell you statistically, that about 85% of all products and services that a member ever uses with the credit union is cemented in their first 15 days. And then there's another tranche up to about 60 days where they had to take the loan applications home, get some documentation, and they wind up getting the loan. And if you're going for cross sales on members that have been with you over 60 days, you're rowing against the stream. You can certainly do it. Segmentation is the key. The right messaging is important, but it's much harder. The time in onboarding is now. So recognizing that engagement metric for that onboarding is critical. And having the information from the credit reports and the FICO pool, the soft pull when they become a member. Also on those mortgage members, when we approve them for a mortgage and they have a nice FICO, why are they getting an instant approval of a CD, or excuse me, of a credit card at that closing table? Just sign this form, return it in your loan packet, and I'm going to send you a credit card because, of course, we know your LTV, we know your income, we know your debt to income ratio, we know your FICO. We would just instantly approve them for a credit card 9 times out of 10. But mining these transactions, and ultimately, we'll get into some more advanced analytics here in just one moment, but ultimately it's about finding the right measured action from these segments within your data so that we can take an action A versus B versus C versus a control group. We want to then modify and reset iteratively through this feedback loop. We may eliminate C, tweak B, and try it again against A versus a control group, and nope, A winds up being the champion, and so that turns into the prescriptive best practice. But ultimately what we want is a prescriptive trigger, and what I mean by that is maybe within a certain segment we see a normal and higher deposit, and so tomorrow we want someone to take action on that, try to get them into brokerage or a higher rate CD. We see a high member in contribution, and they have a dramatically declining member engagement. So someone gets an email and we want to take action on that immediately, right? So those prescriptive triggers, we know that if you take action with this script, you say this at this time, then we have this percentage of success, quantitatively proven, and that will build confidence in the front lines, and you'll help people achieve their strategic initiatives. Now, finally, there's a lot of analysis going on without a lot of math. I say this a little bit tongue-in-cheek, but imagine that on our CECL equation, we are tracking the unemployment rate, the bank loan rates, real exports as a measure of macroeconomy. We've got vehicle sales. Maybe this is total versus in our area versus us versus competition. Our personal consumption and CPI and other metrics, US dollar index, whatever we wind up for all of our macro stats on our CECL, or we just wind up with a prescriptive statistic on, making the offer to this segment at this time, what were the results? Ultimately, what we want to do is within our new member segment or our mature member segment, what's the right message at this right time? We may, of course, what we want is this intersection right here may be success, but ultimately, we're trying to modify as time goes by and get this blue symbol smaller and smaller so that we can better target these areas, measuring the ROI, the cost of the action versus the opportunities within the segment. And so we want to keep focused on that. There is a role for regression. The way that you find, let's say, the way that you tweak, starting with your millennials versus executive versus retirees, instead of using an age equation, is based on the use of those transactions and those services. But which service is meaningful? Which product is best? Which product contributes to the member lifetime value? Which service added on relates to a longer average life or more retention? Or what's the average dollar of member contribution of that checking account and that debit card? Again, we saw earlier that the segmentation is the key. So within each of those two segments, based on how they use the checking account and the debit card, those results are going to vary wildly. But what we do as an example, there's some neural net, there's some machine learning. You can run random forest using something as simple as R from a straight SQL pool. But it's quite easy to take these metrics and do they have this product, yes or no? How many times do they log on to internet banking? Do they do debit card? How many debit card transactions? What type of transactions are they pin or signature? You could get this data into Excel. And from an Excel spreadsheet, we can regress this using a simple a logistic regression. And then you look at the individual correlation coefficients. I know I'm getting a little bit into left field, but you can see mathematically the contribution of different transaction ranges of a different account or service, or having a different product or service and what that means. And then you'll see within those segments that, maybe these are my members, but it's segmented based on millennial versus retiree versus executive. And I really get into this intersection in the millennial and the executive, but not so much in the retiree, right? So you want to find these overlaps, and it may be that a marketing activity that you're doing doesn't get over the ROI hurdle, and maybe we have only a 4% success. But if we focus it only on the millennials via email, my cost is much lower and I wind up having a 40% success. So I could have thrown that action out because it only had 4% success and it wasn't getting over the ROI hurdle. But if I deliver the message via email instead of print stuff mail, and it only goes to the millennials and they actually do respond, then again, that's an illustration of how segmentation is the key, and that segmentation can be revealed through regression. And so I know not everyone can hire a PhD mathematician, statistician, but there are consultants out there that can focus on doing that service for you. And maybe you only need 5% or 15% of a person's time to validate your models or see if there's truths that lie within your models. And so you don't need a 50% person or 100% person. You may get by with 15% of that activity. But again, a lot of opportunities you can do without getting into this complex of math, and just really looking at starting simple, having a goal, seek to deliver an immediate ROI, make sure you consider the opportunities within the data. I gave you probably 10 or 12 of them during this presentation, including one slide that had about 8, another slide had 2 or 3, another slide had 2. So look for those very tangible data segment opportunities that you could extract through OnApproach's M360 queries, or that you can extract using your own BI platform. You could layer over a Tableau or a Power BI to see the truths within that data. But try to take an action, and remember, segmentation is the key, finding that right message for the right member at the right time. So with that, let's open it up to any questions. And I've seen a lot of chat questions coming in. So
okay, thank you, Steven. Yes, the floor is now open for questions. Please, you can use the questions tab on your GoToWebinar screen. You can submit them via chat as well. Steven, I'll start out one that I had as a result of your discussion. You mentioned in the beginning, in your summation there, start simple, look for the ROI and so forth. And I think that that's an excellent piece of advice, but can you give some concrete type of an example of how one might start small in a way that's meaningful,
Sure.
Along those lines?
Yep, several of them. So let's say we want to increase deposits. One easy way to increase deposits would, of course, be to look at my, craft a simple engagement metric. How engaged are my members? Let's say that we're a seg-based credit union, and so I know who you work for, and I just go in and I aggregate all of the deposits that you're making. Or I can isolate your ACH recurring deposit. It's going to be very obvious if you are their primary financial institution. Is the sum of their deposits very low? Like maybe it's just enough to cover that car payment you made to them. And, they're keeping a $5 or $10 balance, and there's a deposit that goes in right before the payment comes out. And so, can you move over their primary financial institution relationship? Another one, Pete, is, when we're done onboarding that loan and entering it into the core, maybe we could take 5 minutes and just power up an Excel spreadsheet and input some information and ask the person in loan operations to say, from a quick review of the credit report, hey, I see that they've got a car loan at Wells Fargo and a Citibank credit card. Great, we just made a loan to that person. We know their LTV, DTI, income, FICO. So it may be a person that we want to send them a send them a piece of mail or give them a call and say, look, I've got an 8% credit card here at the credit union. You're with Citibank. I see you have $8,000. And so I bet you I could save you anywhere from 8 to 10% in a year. And on $8,000, that's $800. So if you get their voicemail, you may be able to be so as aggressive as to say, this is Susie with the credit union. Please give me a call back. I'd like to talk to you about an opportunity where I could save you more than $500, right? Be conservative. That may get a call back. And well, how could you save me $500? Look, I've got a credit card, and being a credit union, I'm not charging 16% or 21%. I'm going to start you off at 8%, given your FICO. You can move that balance over. I'll let you move that over at 5%, right? So just knowing what is in their credit report from the mortgage or the auto loan, or seeing that they're a CD and checking account customer, but a low FICO, and so we can't get them into auto loans. We can't get them into credit card. But if we pitch a CD secured line of credit, then we could help improve their FICO. And I'll tell you that statistically, if you open, let's say, you talk them into opening a $2,000 CD, you give them a 90% collateralized line of credit. So that's $1,800. They keep the balance low. They make on-time payments. You can lift their FICO 60 to 80 points inside a year if they're below 700. And you can, below 660 was that analysis I did. And then after a year, they'll get another FICO boost by having a more mature credit. And so that's a little bit boost to their FICO. So you could make them to where you could get them into the credit card and in the consumer loan, help them improve their FICO. And what a great member service.
Great, thanks, Steven. We have a question from one of the participants. I found that all the data in the world isn't useful unless you have staff available to act upon it. Who do you recommend ensures that the right person sees, understands, and acts upon such opportunities?
Great question. And there's a couple practices out there, the Knowlton Group, Brewster Knowlton, myself, that kind of serve as like a chief strategy officer, but on an outsourced basis. And so, leveraging the OnApproach M360 or whatever data warehouse platform, you can use to get that data aggregated, you may want to engage with someone that has the time. In the credit unions, I know a lot of our line of business leaders wear multiple hats. And we start off with a nice strategic plan. We've got these annual strategic initiatives. Maybe we even broke them down into quarterly goals, but we get mired in the day-to-day HR issues, member issues, this loan problem. It's got to be done this Friday for the member closing. And so all my eyes go and focus on there. And then I get an HR issue that comes up, and I've got a branch opening and the examiners are coming in next month, and I'm in the middle of a core conversion. It's understandable why we lose the ability to focus on achieving our strategic initiatives by revealing opportunities within our data. So rather than hiring, a 20, 30-year experienced chief strategy officer, you may want to engage, let's say for 20% of the cost, and you get someone that, meets with each line of business officer monthly to say, here were our goals. Here's what we set out to do. This is what we tried last month. Here was the relative success. Here's a couple branches or members or employees that were killing it. So let's find out what they do better than all the others. We can share that knowledge, or this isn't working at all. Let's move on to the next idea. Just a monthly iterative process where that line of business leader is forced to stop and consider the strategic, out of their busy days. And then they know that this maybe outsourced person, maybe it's an outsourced person working with a recent college graduate, and you can empower that recent college graduate by linking those two people together So don't let that stop you. It may result in, look, we can prove such ROI opportunities that we're able to justify a more permanent or more full-time resource that kind of takes on that role, and the consultant gets them empowered or accelerates them to be more productive. But using a consultant is also a great way to put a foot in the water, because let's see what these 4 or 5 actions can prove. What's the quantified ROI? Okay, well, that was a no-brainer. We had a 500% immediate ROI. We like what we're seeing. Let's keep doing more of it. Versus, well, that didn't work at all. Okay, great. It was a short-term, small dollar engagement, and now we know we need more work to do before we're really ready to leverage those opportunities. So, a couple of different ways to tackle that, but great question.
This is Pete. Yeah, I agree with that. Again, we're speaking biased from the consultant side of the equation, but our experience has been that, as Steven says, quite a bit of resistance to change sometimes, and big dollar outlays put people off, but maybe a small proof of concept type of project, especially on a high return type of a thing, might be the way to melt the glacier a little bit and get things moving.
Yeah, and yep,
go ahead.
Yes. And some of the data is very easy to get. Let's look at again, an income proxy to sum the deposits. And once you just sum the deposits and maybe store it for 3 months and take a 3-month running average, which you can probably calculate that back 3, 6, 9 months, and so you could have the answer in theory in like a week. And now you overlay that over your members, and some of those members you look at and their seg, or you captured where they work, or maybe you're seeing their deposit come in through ACH, and versus you're looking at, the services that they use with you, and what information do they have, and what becomes apparent is there's a lot of opportunity just with that one more analytic that allows me to segment my members. I mean, why is this segment, in this deposit total dollar range versus this deposit dollar range, or within an engagement metric, or within a mix of products and services, or just my ACH transactional information. I want to pull that out and see, who's got transactions to other banks, right? Or my debit card transactions, more PIN versus signature, or my really good members, I want to make sure to keep them and get more of them. So all of this data is, I guarantee you, sitting in every bank, every credit union BI platform, in every core, and could be easily extracted and start empowering action with, the application of maybe a simple analytic, or it may just be the information itself. So a lot of opportunity not to wait, but you could get started sooner than later.
Thanks on that. Are there other barriers, other obstacles that you see frequently in your practice that keep people from getting started on things like this?
Sure. Culture, staff, other projects, and there's a solution for each of those. It may be that you come up with the best decision-making dashboard in the history of the world, but we've all got 30-year branch managers that still like their yellow pad and pen, and really don't want to get on the computer. And they do because they have to. Maybe they have a secretary that does most of their emails for them, and that it's just not right for the culture. So to those people, you may want to, you could push the triggers to their email instead of making them log on to a dashboard. If they're important enough triggers, like one of our top 2 percentile members with a declining engagement statistic, that could be a, go to one person in the back office that calls that branch manager and says, Joe, right? Yep, I know Joe. Well, he has a declining engagement metric. It may be worth, a series of calls each morning for someone in the back office that sees these important declines within our most important member base. So, to each of those hurdles, we can identify a solution, but the best solution is quantifying the ROI from that action. And if the CEO or president knows that if we take this action, then we make this change and we improve member service, we extend retention, we produce this many more new loans, then, it may be more wherewithal, more fortitude to say this is the action we're going to take, or this is how we're going to change the employee scorecard. You have to have this many activities to where the ideal is they're looking to data analytics to say, give me more data that helps me achieve this goal, right? And then we've found the right segmentation intersection, and they love to get that list. They love to check their morning emails to see if they've gotten any of those immediate triggers, because they know, maybe it's a higher than normal deposit of a good member. And so, hey, it was there. They must have gotten a bonus check. They must have had some nice deposit that's much higher statistically than the average. So let's get a referral to the brokerage person. Maybe I am the brokerage person, and I get that information on my existing members that do or don't have an existing brokerage relationship with me, right? So that's really valuable data for me, the brokerage guy, to get. Or maybe I'm the branch manager and I get paid on brokerage referrals. That's a segment that I want to get, right? So if you find what they're supposed to be achieving and you get them data that helps them do it better, great.
Terrific. Another question that's come through. The questioner says, in Canada, we've had some bad press about staff at banks and CUs with sales goals that can be seen pushing unneeded products. I'm glad to see the emphasis on the benefits of improving credit score and lowering credit card fees from a competitor. It's not only in Canada, we've seen that in the United States, certainly with the big bank Wells Fargo. How can this segmentation help along these lines, where rather than push products that aren't needed, give the credit union an opportunity to provide something that's exactly tailored for the member?
Yeah, the key really is that segmentation of one, right? So imagine that we're just focused on identifying our top member contribution members and getting to know each of them, having an officer name next to each member that's in the top 1%, and then in the top 2%, and then in the top 3%, right? So getting to know that person, having a personal relationship, so that they've got a direct contact person that they can build that relationship for. Talk about a segment of one. What if we have a twice a year lunch with each of those members? And I know there's some members that, may be in the top 1%, but they're just busy and they don't have an interest in having that personal relationship. But some of them may appreciate it, right? And there's different ways that you can get into that relationship of getting referrals from those people too. For example, let's say, again, that you do focus on small businesses. A great added value is, if you haven't heard of IBIS World, and there's a couple others, but they have monthly stats and then a really nice quarterly output to about 770 industries in US and Canada. So let's say that you find out that one of your best members owns 3 dry cleaners. So they break dry cleaners down into national brands, regional brands, mom and pops, people that own, 5 to 10, and you take a 2 or 3 page quarterly output and you deliver it to that member. It's got a section on there, what keeps CEOs up at night. It's got all the industry trends and stats and the trends of that industry. They've got analysts that focus on that segment. And so, you take that information to that person and they really appreciate it. You're just delivering added value. You're not trying to sell them anything. you're just improving the relationship. Now, in that course of business, you may find out that a line of credit could help them, that, your credit card is better than the one that they've got. But you may also be able to ask them, maybe they attend a quarterly luncheon with people in the same industry. Well, can I come and speak? Can I deliver this information to them? They're not even my members. Can I deliver it to them? And after, a couple of quarters, those people are saying, well, shoot, you're doing more for me than my banker. So, I'd love to move my information over to you. Imagine you take the current real estate market value of your members, but not only your members, but also their neighbors, and you send them, a nice little mailer. Here's your average real estate value. And if you'll go to this website, you can give me your email address, put in this property ID, and I know you're not a member of mine, but I'll send you this nice output on your neighborhood and the value of your home each quarter. Of course, now you can market to those people with their email addresses, right? And you're just focused on service. It can be scorecard. It doesn't have to be incentive program, but there's a lot of opportunities that we can do to lift the education, improve the FICO, improve the member experience, build the relationship, extend the average life.
Great. We've got about 3 minutes left. One of the questions that frequently comes up in this situation is that everyone's excited about the prospects and would like to do something, but then they find out that acquiring the data internally is challenging, whether it be an IT problem per se or just a structural problem because the core processor, for instance, is difficult to get information out of. What kind of advice would you have for credit unions encountering those kind of issues?
Yep, so I've got a credit union client that's in the middle of an internet banking, mobile, and core change. Their IT department cannot be bothered with anything, right? They're completely off limits, but they'd like to engage. So we work with a report writer that does the mortgage loan origination platform, the consumer origination platform, small business, we can pull the debit card stats a different way. So it's really just breaking down the credit union to say, how can we get started? What data is available? But basically every core loan origination platform has a report writer. A lot of those reports can go to Excel. People like OnApproach can help you crack the code without involving the core provider on how to get data out of the core. There's a CUSO out of Texas that can help you pull your Scimitar data without involving Jack Henry. And, and then, in fact, that Scimitar interface could then load into M360. But, reach out to someone in that space. Again, OnApproach. I'll throw out another plug for Brewster, Knowlton and the Knowlton Group, or someone like myself, and we can help start cracking that code so you can get started. Don't let any of those reasons be a reason why not to begin, because again, data analytics is a journey. It's a multi-year journey. You need to start it with an immediate ROI contribution, but get started, because the questions you're asking today are probably not even the right questions.
Okay, well, thanks, Steven. We've come to the end. There are some other questions, but those who have sent the questions, I'll forward those to Steven, and he can answer those directly to you via email. I'd like to thank everyone today for attending. There will be a PDF of the slide deck that will be sent to all participants. I want to thank Steven for doing a great presentation today. Thank you very much. I want to thank you, my colleague Mark Ports, for handling the behind-the-scenes work here for the webinar. And with that, thank you, everyone. And if you have any questions or comments, please feel free to email us through the OnApproach info@onapproach.net with any questions or comments. Thanks a lot, and have a great day.